know there is a all nude cruise on Norwegian Cruise Lines?
Yeah, I go once a
that
year
goes
with
from
my
like
family.
Miami. How disgusting has that got to be? Like, it's got to be so gross. And actually, like in the rules, they say that you have to put a napkin or blanket.
You beat me to my
on
question.
A chair.
You beat me to my question because I was like, how do they account for people sitting down on
Right.
things? That's the only thing I wanted to know.
It's disgusting. And it's like in the buffet area, it's all nude. It's like everywhere around
even
the
the
cruise ship.
napkin on the chair doesn't do it for me in the buffet area.
Listen,
Buffets are inherently disgusting.
The thing about these nude places,
they don't really care about those things.
It's never people you want to see. All right?
If you're the person going on a nude cruise, you don't care about the napkin on the chair or the buffet. Yeah.
Right.
You just have some guy's chest hair falling into the salad.
Exactly.
It's so gross, dude.
All right, so let's talk about some things.
Welcome to the show. Wow.
So
that is so nasty.
So I know one of the things that you hate and I hate is the whole "Survive till 2025" slogan.
Can't stand it.
Oh,
Makes
it's the
me throw
worst.
up in my mouth.
Well, a lot of things do that for you.
Yeah, like nude cruises.
So now we're in 2025, right?
Yeah.
And I got back.
And we've survived. Some of us.
Barely. So I got back from the National Multifamily Housing Council conference. So there's some new slogans that have popped up.
You're kidding me.
No. So
is this what NMHC does?
This is all people talk about. I
feel like the whole purpose of NMHC is just to make new slogans. It's a PR thing. You make new slogans.
Yeah, and everyone to like it's
year.
just a bunch of just don't get me started. That's yes.
God.
So
right,
now
let's hear your new slogan.
We got stay in the mix till 2026. So you stay in the mix till 2026.
Okay.
We have persist till 26.
Okay.
I don't know. That's great. And we got fix in 26.
I like fix in 26 because it implies we're not going to do shit in 2025.
Yeah.
But we'll fix it in 26.
Right.
It gives you, your investors and your lenders the implication that or the inference that, you're going to work on these things.
Right.
Yeah, we're going to survive. We're going to do everything we can. And then in 2025, we just gave up. This is next year's problem.
What's 27 going to be? I don't know. What rhymes with 27?
In 27, our property's in heaven because you fixed it in 26.
I love that. That's good. You heard it here, folks.
Don't quote me on that.
All right, let's get into some real news.
So that's disgusting.
Yeah, I know.
I do like the idea that every multifamily power player comes to NMHC and then they sit down. They go, "We need new slogans. We need
yeah.
What do we do about this
It's kind of that icebreaker when you have a meeting. It's the first 5 seconds. So you surviving? I don't know.
Are you surviving? No, we're just gonna fix it in 26.
Let's talk about your favorite guy.
Oh, the big boss, the big hog.
Yeah,
Barry S.
Yes.
Big Daddy.
No one calls him that. No. Barry Sternlicht, the one and only.
Barry Sternlicht. So I don't know if you heard this, but he's bringing it back. Yeah. Starwood Hotels. So he rebranded. It was never gone. It was never gone. He never got rid of it. So ultimately it came from he used to own the big brand that was Starwood Hotels, which had a couple of lines that sold to Marriott. And I think that happened in 2016, big transaction, like 12 or 13 billion.
Yeah.
So then it became SH Hotels and Resorts. By the way, Barry Sternlicht is, and this obviously goes out for his team, it's not just him, but he's like a hotel visionary. It's crazy to see someone who's already so good at real estate and understanding investing and credit, and also the public markets. And I feel like this is his side hustle, where he just creates the best hotel brands in the world. So he still owned, after the sale to Marriott, he still owned 3 chains. And I don't know if, I don't think he necessarily owned these at the time he sold them, but he's got the Baccarat Hotel, which we have here in New York, which is stunning. One Hotels, which to me were always the nicest brand for a really long time, like the One Hotel in Miami, which I believe he sold that. I don't think he owns that one anymore. And then he owns Treehouse. So now that they rebranded SH Hotels and Resorts back to Starwood Hotels, he wants to go on an expansion spree. He wants to open up 22 locations by 2029, which is pretty short runway considering the scale of these things. Like the one hotel on 57th Street. So it's really, really interesting to see this. I think a lot of it's being driven by this resurgence in consumer spending, for better or for worse.
Right.
I feel like you and me have read so many reports where consumers are just racking up credit card debt.
Oh, it's crazy. And they're willing to spend, right?
Yeah. And now we know where they're doing it. They're doing it at one hotels.
Yeah, they're going to one hotel.
They're going to one hotels. And I thought it was really interesting. His portfolio, when it was Starwood Hotels, it spanned over 1,300 properties. So he was in 100 countries, 1,300 properties. That's massive.
Yeah, he bought the Westin and Sheraton.
Yeah.
Huge, obviously. I think that was in like the late 90s.
Yeah.
So he had a pretty big portfolio.
Yeah. And again, for him, he does it so effortlessly where it seems like a side hustle. He's just building one of the biggest hotel chains in the world.
And the one that everyone always talks about is the W, which kind of I think that's what he's most known for in that space, just because it was such a unique brand. He basically saw this boutique sort of opportunity of boutique hotels, but something that maybe you could scale up more. And he was kind of one of the first to brand it the way he branded it, and to have all these cool partnerships and parties and make people feel special. So, and we see that everywhere now. I've seen firsthand how the right platform can make all the difference for advisors and their clients. With decades of collective experience in investment sales, debt placement, and equity placement services, Graysteel has built a culture where collaboration, relationships, and excellence power results. Backed by concierge-level infrastructure, proprietary technology, and an entrepreneurial mindset, the firm enables professionals like myself and our team to deliver tailored solutions, precision-driven pricing strategies, AI-enhanced insights, and exceptional value at every stage. Discover how top professionals are scaling their business and continually unlocking new opportunities for their clients at graysteel.com.
Yeah, it was W hotels were really sexy, and I feel like some of the first hotels that you walk into and the lounge space has a DJ and they're playing, and like people are drinking, was definitely at the W. And he's a pioneer. Like he created their loyalty program. I know he had called it something else, but I think he really pioneered the financing solution. I don't want to call it the financing solutions, but like these revenue streams behind the hotel. So hats off to him. I know he's going to do something huge. I hope if he doesn't still own the one hotel in Miami, I hope he buys it back. I'll tell you one quick anecdote. I was there with a friend whose dad is involved in another business with Barry Sternlicht. And I remember sitting in the lobby waiting for my friend to come downstairs. And I believe Barry already had sold it at the time. And again, who knows what that means if he sold most of his interest, some of his interest, none of his, he could always be involved somehow. But he pulls up to the lobby and he's not the owner anymore, right? And the doors open and everyone's like, oh my God, it's Barry. Like the whole staff jumps and starts moving around, and they start fixing the leaves on the trees. They start rearranging the candles and he's not even the owner anymore. You're saying he was no longer the owner, or he was no longer the partner that's in control of this hotel.
Yeah.
But I remember watching how the people jumped and started fixing the little details that clearly he had paid attention to, because that's what made it that powerhouse of a brand. Followed up by 20, 30 minutes later, we go to the rooftop of the one hotel.
You don't have now you're just bragging.
I'm bragging.
Cool.
I'm bragging. I'm maxing
Rooftop
out
guy.
I'm one of the consumers maxing out my credit card to stay. Mind you, I wasn't even staying there. But I remember watching Barry Sternlicht walk around the rooftop, and he himself had fixed the pillows that were on the cabana seats.
Yeah, amazing.
And I watched him how they do that execution in the middle,
fluff
and move it to the side. And I was like, wow,
classic. That's why he's where he is.
That's why he is where he is. That's why his hotel chain made it. Now on some less sunny news.
Yeah. Chrysler building definitely made it to the headlines this week. For everybody listening who doesn't know or hasn't seen this monumental news, I think people have been in the know that A.B. Rosen, RFR,
which is, big landlord in New York, they lost the leasehold position on the Chrysler building. So Chrysler building is on a ground lease from Cooper Union. Cooper Union's a university here in New York with a really nice endowment. They're like super.
Yeah, and a lot of people don't know this about New York, right? Most of these buildings, they're on ground leases for years
not most,
and years.
but definitely a big number of them were set on ground leases for
100 years can be, right? I mean,
yeah.
And the Chrysler building is a good example where Cooper Union actually, which is college, which actually owned the land.
Yeah.
And they've been leasing the Chrysler building off and on for years. And really, I find it kind of fascinating because the Chrysler building was at one point the tallest building in the world for, I think, 1 year before up until the Empire State Building topped out. And it was built by Mr. Chrysler, right, of the famous Chrysler car company, and he self-financed it. It wasn't built by the Chrysler Corporation. It was built by the family.
Yeah, Daddy Warbucks himself.
Yeah.
So using the Chrysler building as an example, so RFR had stopped paying back in June of 24, right? So this previous summer, they've racked up something like $21 million in arrears. Cooper Union started to sue them. They finally won. RFR is going to leave the building. And Cooper Union's taken full possession. So now, who knows what they're going to do, if they're going to maintain it, if they're going to put it back on the market and try to keep the fee and sell the leasehold again. But it's definitely an interesting time. I think it's also interesting because RFR has kind of had some other headline troubles in the news, right? So this might be a little bit dated at this point. I believe I read it like a month or two ago, but RFR had 14 office sites, 11 which were facing foreclosure, right? Some of the most notable ones were 522 Fifth Avenue. SL Green had swooped in kind of late last year and bought the debt on that building for 60 cents on the dollar. So RFR didn't take the hit, but the lender on the property did, right? And that was kind of the signaling of what's going to happen in this year and maybe why we're not doing anything in 2025 and going to fix it in 26.
Yeah, we'll fix it in 26.
Right? We'll fix it in 26 after it gets really bad in 25. So that was one example. And SL Green, kind of shared their intention that they're definitely, as a lender, you can't say that you're buying the debt because you're going to foreclose on a property. That's illegal, of course, but they're definitely keeping a close eye on RFR in their portfolio. Another example, another lender, Wilmington Trust, who's in their portfolio, and they've had some other troubles in New York. They filed to foreclose on 17th State Street downtown. That was a $180 million loan that happened in December. Another property of theirs, 90 Fifth Avenue, the loan on that CMBS loan got sent to special servicing. That's $105 million.
So these
mortgage.
are all offices, right?
These are all offices.
So this all plays into the whole office distress that's happening that we keep hearing about.
Yeah, look, I definitely wouldn't look at RFR and say that they're failing. They had some monster sales in the previous year, right? And they're, he's definitely a bit of like an Icarus, like flies as close to the sun as possible. But they've had a lot of success. So like they also own the Seagram building, 375 Park Avenue, which is one of the most, iconic buildings that you can own in New York. What they're doing from the leasing perspective at Seagram is incredible. Like they're probably some of the highest rents on Park Avenue. They've pushed their occupancy arguably higher than any other building on Park Avenue. Now there's been some major leases with Blackstone and a couple of other groups, but I think they have, like over 95% occupancy at the Seagram, which is like explain that in the office dynamic in New York, right? Yeah. It's super pocketed.
There's definitely two worlds in the office space,
no
right?
question.
Yeah.
No question about it. So, but the Seagram as an example, even though it's performing so well, even though they've done such a good job with the renovations and bringing that property back to life, there's questions about how they're going to refi over $1 billion in debt when it comes due, I believe sometime later this year. And then he even put up for sale one of your favorite buildings, the 281 Park Avenue South, which is the old
Great
Photographica building.
Yeah.
Right. So definitely one of those landlords to watch in the market, because he's going to have a very interesting 2025.
Yeah, it plays into the whole, what's going to happen, right? With rates where they are, how are groups going to refi out of their current debt? And that kind of plays into kind of the next topic, loan modifications, right? Just across the board, like right now, just over the last 3 years, there's been over 2,700 loans that have been modified, which represents over $35 billion in debt. So a lot's happening, right? I mean, lenders are trying to work as much as they can with their borrowers. The justification for modifying most of this debt is, hey, rates are going to be coming down, right? Unfortunately, what we're seeing is rates aren't really coming down, right? Because there's fears of inflation, and we have Donnie T in the White House, and we thought the Fed would lower rates, but they're not. And so that's one thing, and people don't know. A lot of people don't think about this, but when you talk about the Fed lowering rates, that's normally going to impact short-term borrowing rates first. So we're talking bridge debt, short-term debt like that, 2-3 years. But the other thing is treasuries, right? And because of the inflation, or I should say, because of the inflation fears, and how hot the economy kind of still is, treasuries and the tariffs, right? Treasuries, they're not coming down.
Yeah, so spreads have actually widened.
Right.
I think we've mentioned this before. They've widened about 100 basis points since Donnie came into office, and
it's not what people thought was going to happen, right?
And Jerome Powell's made his qualms about not necessarily lowering the rate. So
long-term debt, still high. You're still looking at borrowing costs in the 6-7 range.
Which, by the way, it's not high historically, and I think a lot of people are finally coming around to this. And it was, we tend to forget history really quickly, and this is something you and I have spoken about, and it comes in these sub 10-year cycles, right? If I look at an analyst who started working, 3 years ago, he's probably like, oh my God, rates are so high, or 4 years ago, right? Like, rates are so high. We used to finance, for
right.
for like 3%. Yeah, but you were alive only when rates were 0%. So it's definitely an interesting time. Like, rates are historically not super high. It's just
compared to where we were.
Just people have made really risky deals banking on a 0% Fed funds rate.
Right. Well, so these modifications are going to kind of keep happening, but they're not going to happen forever because, again, the hope is rates come down.
And they have to fix it in 26.
Come on. So so we'll see. I guess on that topic, we'll talk kind of more about financing. We're going to come back and talk to Robbie Pinkas at Pace Loan Group and just kind of get a feel for how C-Pace loans kind of fit into the mix in that capital stack.
Yeah, I'm excited to hear.
Yeah. I've seen firsthand how the right platform can make all the difference for advisors and their clients. With decades of collective experience in investment sales, debt placement, and equity placement services, Graysteel has built a culture where collaboration, relationships, and excellence power results. Backed by concierge-level infrastructure, proprietary technology, and an entrepreneurial mindset, the firm enables professionals like myself and our team to deliver tailored solutions, precision-driven pricing strategies, AI-enhanced insights, and exceptional value at every stage. Discover how top professionals are scaling their business and continually unlocking new opportunities for their clients at graysteel.com. All right, well, let's get into it. We have Robbie Pinkas from Pace Loan Group on, and we're going to talk about Pace loans.
Yeah. C-Pace financing.
Yeah.
Exciting times. Well, thanks for coming down.
Thanks for having me.
It's great to have you. We'll have your dog on next time once I have Jack on medication.
Yeah. So C-Pace is an interesting way to kind of fill the capital stack. It's kind of a form of gap financing.
Yep.
Not a lot of people know about it.
Yeah. Why don't you give us a lowdown?
Totally.
Yeah. So, I mean, we'll start with the acronym. So CPACE, CPACE, stands for Commercial Property Assessed Clean Energy. In some states, they tack an R on to the end, CPACER, the R is for resiliency. It is, yeah, as you said, a type of gap financing. We're usually limited statutorily to about 25 to 35% of a property's value. And the financing can only be used to pay for improvements or measures that make a project more sustainable or more resilient. When you zoom out, though, that is a lot of what goes into a building. It's the entire building envelope, walls, roof, windows. It's all the major systems, mechanical, electric, plumbing, it's elevators, vertical transportation. And in some markets that include resiliency, it's things like the structural system, because that's really important for seismic hardening. It's roof flashings in hurricane-prone states. It's stormwater detention tanks and flood mitigation in sort of the mid-Atlantic. So we don't have a problem hitting that 25 to 35% number. The real question is just what makes sense for the whole capital stack.
And it's all state by state.
It is state by state. So it is not a federal program. It's also really important to note that it's not a subsidy. We are private capital. We charge an interest rate and we are paid back. But yes, it's enabled by state legislation. Then there is a program administrator that designs program guidelines compliant with the state legislation. And then it is ultimately enacted by local municipal ordinance, either at the county or city level. And all three of those things, state enabling legislation, the program development, and the local ordinance, need to be in place before we can complete a financing.
So those municipalities, in essence, are really just setting the guidelines for what they want to see done to properties.
Yeah, it roots back to two things. There's obviously public benefit in encouraging development and growth, and there is public benefit in ensuring that growth is sustainable and kind of aligned with things that will benefit the entire city.
Understood.
And just from a rate perspective, is this based off of SOFR, or is it fixed? Is it floating?
Yeah, really good question. So PACE is always long-term, fixed rate, fully amortizing financing. So we will price as a spread to the 10-year treasury. That spread will be locked when we execute a term sheet. The base rate will continue to float until a week or so before close, and then we will fix the rate for the entire term. We can be prepaid. They're subject to prepayment penalties that burn off by about year 5, negotiable. Mm-hmm. But yes, it is a fixed rate term form of financing.
How does it tie in to, say, a primary lender on a deal? Do they have to obviously sign off on that and have some comfort around it?
Yeah, so this links to one of the critical differences between CPACE and traditional financing. So traditional financing is secured by a mortgage lien. There's a deed in trust. Our security is a special assessment that's recorded against the parcel, which means that we are repaid alongside your real estate taxes. This is why it's so important to have kind of the municipal ordinance, because we are reliant upon the municipal billing, collections, and enforcement infrastructure. Because we are effectively a real estate tax, the current payment, so the amount due in any one period, it's typically 12 months, but in some markets like New York, it's biannual, primes the senior position because it is effectively an operating expense. So this means that it's really important for other lenders in the capital stack to understand CPACE and consent to it. The reason it's not as scary as it sounds is that the outstanding balance is subordinate to the senior lender's position and can never be accelerated. So even if you miss a payment, the only amount that we can enforce is the past due amount, just like with a real estate tax. And we are ultimately reliant upon the municipality's enforcement measures, which honestly take like 3 years sometimes before they can force a sheriff sale.
So Robbie, could you elaborate on that a little bit more? You said the outstanding balance of the PACE loan is subordinate to a senior position?
Correct.
So how does that work?
Yeah. I think that the way to answer that question is it's just the nature of an assessment.
Okay.
The nature of an assessment, like a bid tax or a Mello-Roos financing in California, it's just the obligation to make future payments, right? So we don't have a deed in trust. We can't foreclose. We can't impede a senior lender's foreclosure. We simply have it's no
cash flow or a waterfall priority in essence, right? Because you have to pay your taxes.
You have to pay,
and
your
the lender's
taxes.
going to make sure you pay your taxes before you pay them anyway.
So it's just the nature of CPACE. We are passive capital. So if the payment is made, we actually have no rights, and we only have rights if a payment is missed, and we are only allowed to enforce that past due amount. So it's simply the sort of way that this entire type of financing is structured.
What happens in the event that let's say a senior lender forecloses on a property?
If a senior lender forecloses on a property, then they are now the owner of the property and they are responsible to make the PACE payments. PACE is, as an assessment, it is fully assumable. It runs with the land. If a property is foreclosed upon or sold, the future owner can elect to keep making the payments or to repay us and take us out. It's bespoke. So another interesting thing about CPACE is that you can finance forward-looking work. You can also finance retroactively recently completed work. So it can be used as a construction loan takeout, or it can be used as a liquidity injection to come in for a project that's over budget or taking longer to stabilize. And in the event that a property is cash flowing, we don't need to have capitalized interest or interest-only periods. It just depends on what the cash flows look like.
How far back retroactively can you go?
That depends state by state. Mm-hmm. In most markets, it's 3 years. So in New York, California, Florida, it's 3 years. In some markets, it's 2 years, like Tennessee. And in some markets, it's 1 year, like Connecticut.
Okay. Well, I think this is best explained in kind of some examples, right? I mean, I know you probably have all sorts of crazy scenarios people have used CPACE on.
Yes, I came prepared with two.
Great. Let's hear it. Yeah.
And they're both deals that I closed in Q4. So the first one is mid-construction financing of a really esoteric facility built in St. Louis County in Chesterfield, Gateway Studios. It is the world's largest soundstage. It's like 20
this
times
is huge.
the size of this.
What are you talking about?
And it is purpose-built to support the live events industry. So they've built 5 soundstages, as I mentioned, including the world's largest, which is the size of a football field. And it's designed for artists like Taylor Swift, Kenny Chesney, Beyonce, who are going on stadium tours. So they have one room that's big enough to sort of fabricate and rehearse their entire performance, make sure they get the lighting down, all the AV stuff, practice kind of construction, deconstructing.
I didn't even realize that was a thing.
All the loading. Yeah, I mean, you gotta get it right.
I just always thought artists do that at the stadium like a day or two prior.
Not anymore.
Not anymore. Now you can fake it.
Thanks to CPACE.
Yeah,
this is where they're gonna do. This is where they're gonna do AI concerts.
Yeah.
It's just gonna look like Taylor Swift sold out an arena.
You won't know any better.
You won't know any better.
You're right, though, in that before this, I mean, this facility hasn't even come online yet. There's one facility in Pennsylvania that's smaller, so they have to kind of divide and conquer. But prior to the opening of that facility, you would actually go find a stadium that was sort of off-season or out of use or about to be torn down and use that as the rehearsal space, which is challenging.
That's pretty funny. So you said this was a mid-construction?
Yeah, so it's the project, as all projects do, took longer and cost more.
Got it.
So they went out for financing. Obviously, this is a really esoteric asset. Traditional construction financing rates were through the roof. They didn't want to pay that much. And so they were sort of open to alternative financing. And CPACE really fit the bill. It's a 300,000 square foot facility. There's, I think, $40 or so million of eligible measures. And we provided a $35 million loan to get this across the finish line. Project should deliver later this year. So good example of PACE being used to provide financing where traditional financing was prohibitively expensive.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free. So, Robbie, you said the nature of the loans is long-term fixed rate. This sounds almost like a bridge loan in this scenario.
It
like
can
a short-term
be
loan.
used as a bridge loan.
So how does it work? I guess, can you be prepaid early?
Yeah.
Okay.
You can. You could prepay us the day after close. There's probably going to be a 5% penalty for year 1 and 2, and then that'll start to burn off. By year 5, it's generally 1% or less.
So that's the structure of the 5.5 for, or is it even shorter than that? Or is it bespoke?
It's bespoke.
Got it.
So,
But there's never a lockout period.
there's never say never.
Yeah.
I could see us negotiating a lockout period if someone wanted the lowest possible rate, right? Like when we're thinking about how to structure our yield to worst, there's sort of 3 variables. There's the origination fee, which is what we get paid at close. There's the actual rate that we're paid for the financing. And then there's the prepayment penalties. So we sort of move the 3 around in a bespoke manner to align with whatever the asset's business plan is. So if you're using PACE as bridge financing, you're probably going to pay a little bit more, maybe a higher origination fee, higher spread in exchange for lower prepayment. So you can take us out after year 3 or 4.
So what I'm curious about before you get to your second story, it's not common that a lender does, bridge and senior and, kind of like I don't want to call it a mezz slug, but that 15 to 20% piece. How do you guys price relative to conventional financing?
So we price, as I said, a spread to the 10-year. We're generally in the mid to high 3s. Today, that puts us above 8% because the 10-year is at close to not an all-time high, but a relatively recent high. If the 10-year stabilizes somewhere in the mid 3s, I look at PACE costing between 7 and 7.5%. It will be slightly more expensive for the esoteric or out-of-favor asset classes, but the nature of our security is so protected that the spectrum between our sort of most secure and our riskiest loan is just much tighter than for a traditional lender that might have hundreds of basis points between like a multifamily asset and something really speculative.
That's what makes this super interesting, because when you describe the nature of the loan, my head immediately jumps to, oh, this is cheaper than senior rate debt, but not necessarily.
Not necessarily. It depends on the asset class. And so the question I always get as an originator is, why should I use this? And my answer is, it depends. What financing is available to you, right? If you can get cheaper financing, do not use us, right? Like pay the as little as you possibly can. But for many asset classes or for many sort of project types, the debt that they're being quoted on the open market is more than what we cost.
So you walked us through the soundstage. Give us your second example.
Second example is a retroactive financing, downtown LA office tower, late 70s, early 80s vintage, Class A at the time, had been acquired pre-pandemic by someone who was scooping up dated Class A office projects and modernizing them.
This isn't Union Bank building, is it?
It's not Union Bank building. It was, I think, formerly the Citibank Tower, but it is now open for a naming opportunity if anyone listening is looking for a
it's
your
LA
next project.
I'm going to put my media group in there.
So the owner had put in a new central plant. They modernized all of the common areas. They put in new restrooms throughout the building, new elevators. They spent over $30 million kind of bringing it up to speed. Unfortunately, as we all know, not a great time for office the past couple of years. So project ended up being taken by the mezz lender, who is now the owner and is looking for ways to basically generate some liquidity to pay for TIs and LCs to get the project back up to 80, 85%. They're, as they should be, reluctant to just come out of pocket. So really good use case for PACE. We came in, retroactively financed these recently completed improvements and gave them $24 million, which is basically now a fund to pay for TIs and LCs. And they're now, because Brookfield has kind of closed the purse, the only project in downtown LA that has money for TIs and LCs. So anyone that wants an office there is going to go here.
Wow. And they can draw upon that when needed.
I mean, once, if the work's in place, that money is yours.
Okay.
Right? Like you could repatriate equity, you can pay down senior, you can pay for artwork, like whatever you want.
Yeah, that's a very interesting use case where you don't necessarily need an appraisal to justify that value. You're looking at the actual work that's been done, and you can go off like contractor receipts, for instance.
We're still going to need an appraisal because we want to understand where we are from an LTV perspective. But yes, like once the work is in place, it's your money. You know, I think this is a good time to probably point out one of the sort of again, because the nature of our security is an assessment that's recorded in the full value at close, we have to fully fund at close. So for future projects, forward-looking work, the money goes into an escrow account and is drawn down as the work is completed. And in that case, we're really specific. Like if we're financing the windows, we're going to make disbursements as the windows are installed. If the windows are already installed, then that money is just available to the borrower group.
Well, I think this is really interesting. We're kind of running low on time, but tell us what's the best way for folks to get a hold of you?
Yeah, this is my plug.
Plug it.
Yeah,
let's go.
My phone number and email are on the PLG website, goplg.com. It's also pretty easy, Robbie at paceloangroup.com. And yeah, I'm always happy to chat. PACE is not right for everyone, but it's my job to figure out what projects will benefit from PACE, and I am always happy to chat. So give me a ring, I'll answer your questions, and we'll figure out if there's a there.
Awesome. We definitely seem well-versed, and thank you for coming on.
Yeah,
thanks for giving
Thanks for having
our
me.
listeners some insight.
Cool.